NVIDIA's stock is down about 5% following their latest earnings report, and investors are naturally worried and are asking themselves, does this stock still have room to run, or is it about to crack under its own weight? Because here's the thing, right? NVIDIA controls, they have 92% of the global GPU market share. They just hit a $4 trillion market cap, and now they've been cleared to sell AI chips to China once again. And if that's not enough, NVIDIA just posted $46.7 billion in quarterly revenue. That's up 56% year over year, and net income, $26.4 billion. Those are insane numbers. But the stock still dropped after earnings. Why? Well, when you're the king of the hill, the market expects you to keep climbing higher. Even record-breaking numbers can look not good enough. And yet, there's one signal I'm watching that I think could prove all of the skeptics wrong. It's about NVIDIA's Blackwell chips, and if I'm right, I think it could extend the AI growth runway way beyond what Wall Street is pricing in. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/RickO to get your 10 stock picks right now. In this video, I'm going to show you what I see, both the upside and the risks, so you can decide whether NVIDIA stock is still a buy. Hi everyone, my name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. It's a good thing. I'm not here to sell you any expensive insurance policies. I break down the numbers to help retail investors make smarter, more confident decisions with their money. So, is NVIDIA priced to perfection, or is this just the beginning of the next bull run? Let's find out. So, NVIDIA dominates the accelerated computing and AI hardware market. In fact, they have 92% of the entire GPU market, whether it be for personal computing, gaming, and of course, data centers. And this is incredible. But here's the kicker, right? When one company nearly controls an entire market, the question becomes, how long can that dominance really last? The company's next generation chips, like the Blackwell series, are the company's backbone of AI models that are used by the biggest companies in the world, like OpenAI, Meta, Google, and Amazon. So if you used ChatGPT, Instagram, or even made a search on Google recently, you've indirectly touched NVIDIA's technology. That's how deep this runs. And because of all of this excitement, NVIDIA has just become the world's first company to reach over a $4 trillion market cap, and now it's received the green light to sell AI chips to China once again. Some analysts think that this could catapult the company even higher. But could it really be the case for NVIDIA? Well, this is where the story gets interesting, because trillion-dollar valuations, they don't go up in straight lines. Okay, so let's talk about the stock price, right? Because that's why you're here. By the way, if you want to follow along, just scan this QR code. At the time of recording, NVIDIA trades around $170 a share. And the stock's been seeing some pullback after its latest financials were released. It even dipped to a session low of $167.22 on September 2nd, and has been down 5% in the last 5 days. However, if you zoom out a little, NVIDIA is still doing fantastic. The stock's up 27% year to date and 43% on a 1-year scale. So short-term traders might be sweating, but long-term investors, they're still way in the green. My guess is that some investors cashed in a little, right, after the August 27th financial release. But was there anything about the numbers that scared them off? Well, let's see. Compared to the same period last year, revenue exploded 56% to about $46.7 billion in the most recent quarter. And for the company the size of NVIDIA, this is nothing short of amazing. You could say that NVIDIA They're growing like a startup, except it's one of the most valuable, one of the largest companies in the world. Meanwhile, gross profit jumped nearly 50% to roughly $33.85 billion, which shows you the incredible pricing power that the company has. Operating income, it rose 52% to $28.4 billion, while net income climbed 59% to $26.4 billion. All of these were driven by NVIDIA's data center segment, which is basically their AI business. The segment's revenue rose 56% to $41.1 billion and now makes up nearly 90% of the company's total revenue. That's not just diversification, it's concentration. And when one segment carries almost everything, it's both their biggest strength and the biggest risk. NVIDIA is also sitting on $11.6 billion in cash and cash equivalents, which is also up 36% compared to the same period last year, giving them a ton of flexibility to invest in R&D. Overall, NVIDIA met and exceeded expectations, and yet the stock saw a drop when these numbers were released. And it's now moving sideways at best. This is where investor psychology starts to come in. Sometimes great just isn't good enough. And that's the inherent issue with being at the top. The market expects you to keep pushing the limits. When growth is already sky high, even strong results can look not strong enough in the eyes of investors. But can NVIDIA's gravy train keep going? Well, for that, we need to look into the catalysts that could propel the stock higher. The first is Blackwell. This thing is absolutely flying off the shelves. In NVIDIA's latest report, Blackwell data center revenue grew 17% sequentially. And the company reported that Blackwell sales were led by the large cloud service providers, which represented about 70% of their data center revenue. Translation? The biggest buyers in tech, the Amazons, the Microsofts, they're basically financing NVIDIA's growth engine. CEO Jensen Huang described the demand as extraordinary and even stated that they've successfully ramped up massive scale production of Blackwell AI supercomputers. He also included that Blackwell Ultra is going ahead at full speed, which tells us about the potential demand of these AI infrastructures. Reasoning AI models will most likely be another huge growth driver for NVIDIA. In one of their earnings calls, management explained that these long-thinking, reasoning AI models can require 100 times more compute power per task compared to the one-shot inferences. And in plain English, smarter AI is hungrier AI, and that means more NVIDIA GPUs. And essentially, that means that DeepSeeks and other large language models, they're not reducing demand for NVIDIA's chips, they're actually increasing it. Because if you want a more efficient model, you need more computing power, which means more GPU clusters, which also means more demand for NVIDIA's high-performance chips. Management also stated that the vast majority of their compute today is actually for inference, not for training. And I think that's the notable shift that would extend the growth runway way beyond what anyone ever expected. NVIDIA is also spending massively in AI infrastructure. In its most recent report, management said it expects between $3 and $4 trillion in AI infrastructure spending by the end of the decade. Hyperscalers, they've also doubled their capex to $600 billion per year. But despite all the talk about efficiency improvements, the CEO highlighted that the figures will only continue to grow. So every dollar saved by efficiency gets reallocated into buying even more compute. And that's exactly what I think is fueling NVIDIA's future. And not only that, considering that nations like Germany are now seeing the potential of AI for their own use, these entirely new customer segments will provide an extensive growth runway for the company. Another potential growth driver is NVIDIA's robotics and automotive division. In its most recent quarter, this segment hit $586 million in sales, growing 69% year over year. Sure, It's still small compared to data centers, but that growth is absolutely impressive. Remember, physical AI is becoming real, and I think NVIDIA's positioned perfectly to capture it. So while everyone is focusing on data centers, I think the real growth story might turn out to be robotics and autonomous vehicles. Now, let's talk about the elephant in the room. The risks here to NVIDIA are very real, and it's something that we've discussed in my Discord server. First, it's the China situation, and I'm not going to sugarcoat it. Back in April of 2025, the US prohibited H20 exports to China, and NVIDIA took a $4.5 billion charge in Q1. They were unable to ship an additional $2.5 billion of the H20 chip in that period. And in the recent quarter, zero sales to China. Nothing, nada. Jensen Huang literally said that the $50 billion AI chip market in China was effectively closed to the US. Now, NVIDIA has had some headway in getting the required licenses to ship to China, but there are two big interconnected issues with that. First, the company is still going to sell watered-down versions of their Blackwell AI chips. So even though Uncle Sam gave the nod for NVIDIA to ship to China, the country is not going to get the best silicon. Which leads me to the second issue. It's the time that NVIDIA lost. It's never getting it back, and in its absence, the competition has been ramping up. There's also AMD's MI300X, which is gaining a lot of traction. In fact, Microsoft chose them as their internal AI farm as a second source. However, Chinese competitors haven't been wasting their time. Cambricon, for example, they're a direct Chinese competitor, just posted a 4,300% jump in revenue, at least according to its latest financials. And that's a classic case of a market rushing in to fill the vacuum that NVIDIA left. And to make matters worse, the Chinese government is allegedly discouraging local firms from buying from NVIDIA and other US chipmakers. And then we have the hyperscalers. They're also building their own custom silicon as a way to reduce reliance on NVIDIA. For example, Amazon with their Trainium 2 and Google with their TPUs. It may not totally hammer NVIDIA's sales, but I think it'll certainly affect margins to some extent. So while the bull case is strong, the bear case is building up quietly in the background, and the smart investors need to track both. Despite the risks, a consensus among 46 analysts rate NVIDIA stock a strong buy with a high target price of $250 per share, which means they see as much as 43% upside from NVIDIA's current levels. That said, NVIDIA stock is expensive, with a forward PE at 42x, which is notably higher compared to its closest peers. At this point, I can say that it looks like NVIDIA is priced for perfection. So overall, NVIDIA's been seeing some stock price weakness, but this is usually expected after massive bull runs, which NVIDIA has effectively been on for over 3 years. Still, the Blackwell ramp-up, I think, is just the beginning. I think we're in the first innings of a product cycle that could last for years. And with reasoning AI requiring 100 times more compute, well, look, every efficiency improvement just creates more demand for inference, which needs even more chips. So I think it's a beautiful time to be an NVIDIA shareholder. And that's the paradox, right? Because efficiency creates demand and demand fuels growth. So with all this out of the way, who's the stock for? Well, if you're a growth investor who believes in AI and can handle a little volatility, I think NVIDIA is the best one out there. So that's my take on NVIDIA. But what do you think about the company? What do you think about what they're doing? What do you think about the risks? Let me know in the comments below. And while you're there, if you found this video helpful, do hit that like and subscribe button so you'll never miss any of my future videos. That's it for me today. I wanted to thank you so much for watching, and I'll see you next time.